Okay, good morning everyone. Thanks for tuning in. Welcome to the first in a series of webinars brought to you by the recently launched ESG Social Housing Working Group. I'm Luke Cross, I'm editor of Social Housing magazine. Delighted to have been asked to chair this session today, and also very pleased that Social Housing magazine is now part of the ESG Social Housing Initiative, which has been launched in an effort to create a standardised approach to ESG reporting across the sector. Today's session is called What ESG Reporting Means for UK Social Housing, and it's been organised by The Good Economy and hosted by Trowers and Hamlins. Over 350 of you have registered to participate, which is fantastic. And this session is all about the drivers behind the launch of the initiative, exploring why the movement matters to UK social housing and the financial community. So we'll be hearing from the people leading the working group about their sector-wide consultation, which you can find at www.esgsocialhousing.co.uk. And we look forward to hearing from all of you throughout the Q&A today. While today is about providing an introduction to the initiative and to ESG more broadly, the next three webinars in the coming days and weeks will delve into the specifics of the E, the S and the G. So today our panel includes Phil Jenkins, MD at Centrus, Gareth Francis, Director of Treasury at Clarion, Anthony Marriott, Head of Treasury at Peabody, Mark Davie, Head of Social Housing at M&G, Marcus Navarro, Director in the Housing Finance team at NatWest, and Sarah Forster, Chief Executive of The Good Economy. So we'll take 5 minutes, up to 5 minutes from each panellist. Then once everyone has said their piece, we roll into Q&A. So please use the Q&A button at the bottom of your Zoom screen to post questions throughout the presentation. And finally, this session is being recorded. So once you've experienced it, you can share it or you can rewatch it at your leisure. We'll be sharing a Vimeo link to the recording afterwards. So I'm going to pass over to Phil Jenkins to start us off with presentations.
Great, thanks very much, Luke, and good morning, everyone. It's good to have a great turnout today. Obviously, we're into the consultation process now on this project. So I was just going to take the opportunity to perhaps frame the work that we've done and how it all started. And this goes back well over 6 months now to a meeting that Susan Hickey and I were in when she was still at Peabody, where we sat down with an investor that was looking at Peabody as a potentially new home for investment. And there were a number of ESG questions coming across in that meeting, and you know, I suppose we both felt that was a new theme from the investor side, and we sort of sat down after the meeting and thought, you know, in recognising that this was a big theme coming down the tracks, there wasn't really a kind of standardised or recognised way for the housing association sector to report on what it does on the ESG side. And I think also perhaps a bit of complacency in relation to other industries, based on the fact that, you know, most housing providers would consider themselves good corporate citizens and you know, strong on the stewardship side. So, but it wasn't really sort of, the sector wasn't really articulating that in a sort of clear and consistent way. So what we set about in setting up this group was really trying to move towards a standardised framework for the sector, where we wouldn't have to have lots of housing associations reinventing the wheel, and hopefully neither would we have lots of investors and banks on the other side putting their own individual versions of ESG data requests and questions to housing associations, which, you know, would clearly be very inefficient from a reporting perspective. So, I mean, first of all, on the theme of ESG itself, I mean, it's a real juggernaut coming down the tracks in terms of, you know, the weight of opinion and momentum behind it. You know, if you think of all of the types of organisations that institutionally invest in the housing association sector, be that banks or asset managers, pension funds or insurers, all of those entities are facing significant pressure from from shareholders, from regulators, from government and policy makers, from underlying investors, trade bodies. So, good example is asset managers that are all facing pressure from underlying pension funds that they invest on behalf of. The pension fund trustees themselves facing pressure around ESG. So there's almost a sort of stream of pressure coming through to the people that will be investing on the front line. One pension fund that we spoke to through this process articulated what I thought was quite an interesting thought, that for them going forward, ESG will become as important a factor as the balance sheet an income statement of a potential borrower, both in terms of the upfront work that they do at inception of an investment, but also on an ongoing reporting basis. We had a question the other day from a client of ours, a chief executive on this ESG theme, and she asked if ESG was going to reduce their cost of funds, and was it worth the effort? And this is a question that's come about frequently in the course of the work that we've been doing. And I think it's important to step back from that and probably understand that with the way that the ESG is going, to my mind, it's less about reducing your cost of funds and more about, if you like, a basic hygiene test on the part of investors in your business. So if you want to continue attracting competitive and well-priced debt from the markets, you're going to have to be ESG compliant at a certain basic level. Now, above and beyond that, I think this provides a useful launch pad into things like impact finance and other areas where you may well be able to reduce cost of funds. But what we're talking about here is everyone meeting a certain basic level of compliance, and that's hopefully what the outcome of this project will be. So that's all I wanted to say at this stage, and I'll now hand over to Gareth Francis from Clarion.
Failing the first basic test of finding the mute button. Thank you very much, Phil. I won't go on for too long. I think Phil makes a lot of the points which I would make with regard to why I'm supportive of a sector-wide approach and why I'm interested in doing it. But I think it's worth mentioning a few of the points that are personal to me. I, like perhaps everybody on the panel and tuning into this webinar, have a passion for the sector and what it does. And it's got a great story to tell, but it's got the potential to expand further the impact on the positive impact on society. So that's a bit of the potential around ESG. I think, as Phil said, there's quite an inflection point in last year in the demands of those that are trying to raise capital, and it's no longer good enough just to be a social housing provider. We need to be telling a clear evidence-based story of where we are now, where we're going, and how we're going to get there. But I think that's again, that's something that we can all do well, and if we all do it together and in a uniform way, it should be more powerful. It should, as a whole, benefit the sector, because it will make the sector more investable and increase the impact that their sector has in achieving some of those societal goals, be they achieving our carbon reduction targets as a complete society, or better serving society in all of the ways that housing associations are used to. We want to provide a good home, if you like, for capital, but also to contribute to those societal goals. And ultimately that's about that kind of chimes, I think, with everything that is set out in international standards around ESG, about lives and communities and economies, people and planet. How does it help housing associations? Well, again, coming back to that carrot and stick, to a certain extent, you know, we have to tell a story if we want to raise capital, and that's, you know, there's going to be an increasing requirement. Will be an increasing bit of a stick, if you like. I agree with Phil. I think there'll be a disbenefit for not doing this to a certain level over time. But I think actually the benefit of doing it is, again, you get to tell your story, and you tell your story in a much more effective way. And I think also working together, and there's a long history of the sector working collaboratively together, and I think this is a great example of it, and has the potential to really pull everybody together. And where the sector does work together well, it really makes a difference. We need to challenge not only ourselves, and you know, that might be internal, or you know, it might be in a bit of competition, but also our supply chain, and make sure that we are really promoting the potential for good as much as possible. And I think you only do that if you standardise your approach, and you face the market and you face your suppliers in a similar fashion. So personally, I think it builds momentum. A standardised approach builds momentum for further positive interventions by housing associations and their assets and services. So that's why I'm wholeheartedly behind it. And I think at that point I'll hand over to an investor to hopefully collaborate and confirm some of those conclusions. So without further ado, Mark Davie.
Thanks, Gareth, and good morning, everyone. For those of you who don't know me, my name's Mark Davie. I'm Head of Social Housing at M&G. I hope you're all well and are adapting to this new world in which we all find ourselves as a result of COVID-19. I think this is week 10, or it might be week 11 of me working from home, but I'm getting used to it now, so I hope the rest of you are too. By way of background, M&G manages just over 6 billion of debt investments into UK social housing across about 130 housing associations and 20 different investors. We like social housing, and so do our investors. And one of the reasons we like investing in housing associations is because of the positive social impact they bring to our society. And that has always been kind of taken as read, if you like. I've never really had to try too hard in credit committee on that particular score. However, as previous speakers have said, that's no longer good enough, and investors are increasingly asking more searching questions across all sectors, not just in this asset class. These investors are largely pension funds, although there are other investors into social housing, obviously. Pension funds which are driven by people like you and I saving for their retirement. Those people, you and I, they understandably want reassurance that the world's resources will be consumed responsibly, that homes are safe and maintained to a good standard, that people, that's employees of housing associations and their residents, are treated with dignity and respect. And they want to know that the organisation they're investing in has good leadership and strong governance. The problem in this sector has been not that housing associations are bad at ESG, they're not, but they have traditionally been poor at communicating all the very good things that they're doing, the progress they're making along the ESG path and their plans for the future. And that, of course, is a generalisation, and I accept that some housing associations are doing an excellent job of communicating their ESG credentials. So as a result, investors and asset managers like M&G have started to develop ESG questionnaires so that they can more rigorously evaluate issuers' performance against some of those criteria. And indeed, M&G has developed a set of questionnaires for certain asset classes. The problem, of course, for housing associations is that every investor has a different level of knowledge and expectations and will inevitably ask different questions. And the problem for investors is finding the information they want in the form in which they need it. So when the opportunity arose to join the working party that helped develop this white paper that you've all, I hope by now, have all seen, frankly, we jumped at it. Rather selfishly, we did not have a questionnaire for this sector and needed to develop one anyway. And it seemed to us to be pure common sense to try to do what this sector has successfully done with many other important sector-wide issues over the years, and consult with all stakeholders so we can understand each other's issues, capabilities and desired outcomes, and can work together to produce a mutually satisfactory solution that everyone can buy into and ultimately use. So if the sector can agree a broad consensus and consistent ESG reporting approach, this will make evaluation and ongoing reporting much easier for investors. Cross-sector comparison should be easier, and by that I mean inevitably this sector is compared to, for example, real estate and other sectors when investors are deciding where to put their money. And that in turn should help to attract and maintain a strong and diverse investor base. Knowing what they need to report will also make things a lot easier for housing associations and their boards, and as the previous speaker alluded to, remove a lot of duplication and separate effort. That's it from me. I'm going to hand over to Anthony Marriott now, who is Head of Treasury at Peabody, who will give you his perspective. Thank you.
All right, thanks, Mark. Good morning, everybody. I'm Anthony Marriott, Head of Treasury at Peabody Trust. A few quick points from me in terms of why I'm supporting a sector-wide approach. I think really I want to promote greater understanding of reporting. If we can all report the same thing, if we're all talking about affordability in the same way, if we're all talking about placemaking in the same way, if we're all talking about resident support in the same way, that's got to be a good thing. I'm sure a lot of us are going through preparing the accounts at the moment on a broadly consistent basis. And if we can do a similar sort of thing with ESG, that's got to help. Secondly, I think it also brings out the genuine societal good that is at the heart of registered providers of social housing as a sector. But it also presents us within a context of being well-run, financially stable organisations. Thirdly, I think there is something in terms of what Mark just touched on with regard to benchmarking. I am genuinely hoping that this will actually lead to some improvement in certain behaviours, particularly on the environmental side of things, where I think there is a bit of a stretch for us to achieve new things in the future. Why do I think it's an advantage for housing associations, particularly to get involved in this? I think Mark has alluded to some of this in terms of investors, funders, banks, helping them to understand the sector better. When I've been in meetings with some of these guys now, they're bringing their own ESG experts into the room. I've certainly had 4 or 5 questionnaires come through in the post asking us various different things. We need to be talking the same language as all of these guys. It is going to be the basis of reporting in the future. This isn't going to go away. It's just going to increase. Secondly, I think it helps to bring a broader understanding of what not-for-profit HOs are really about. It's somebody that's come from outside of the sector. I wasn't too aware of all the genuine good that is going on. And I think the criteria allows us still to report that, but also to bring out the uniqueness in particular organisations. So there is space to talk about your care and support business. There is space to talk about the difference between your rents and what market rents are in a particular locality. Thirdly, and the reason why, or part of the reason why we started this project last year is really that we did want to get access to new pools of funding, whether that be through existing investors, whether that's new investors coming into the sector, whether that's innovation funding, different types of things that might come up. And yes, I guess also I'd like to perhaps pinch some good ideas off other people as well, see what people are doing, and try and bring that into our own organisation. So that's all I really want to talk about. So now I'm going to hang over to Marcus from NatWest.
Cheers. Yeah, so Marcus, director at NatWest, and look after a sort of portfolio of housing association clients. I think it's probably just worth giving, again, just giving a bit of background in terms of NatWest and the bank and the wider group. Ultimately NatWest is a purpose-led organisation. I think it's fair to say that we really believe in the sustainable banking and the wider ESG agenda. In terms of bank support for housing associations, we've probably got about over 260 clients across the UK. We've probably got about 12 billion of commitments to the sector, and in addition to that, we're one of the leading providers of capital finance, capital markets finance across public bonds and private placements as well. So what that means is it gives us a good opportunity and a great insight into the sector. I think it's fair to say that the mix of clients that we've got range from small housing associations, medium to the largest, and we really understand the regional differences and the differences in terms of regulation and some of the challenges that might bring as well. So like I say, that gives us a good sort of insight into the sector. As an institution, we've developed our group's green, social and sustainability bond framework last year. So that resulted in our first social bond issuance. And this was the first time social bond issuance for a financial institution under ICMA's social bond principles. And that transaction was to support lending to SMEs in the area of deprivation. And this was also followed by our first green bond last week, which was the first green issuance by a UK bank in US dollars. So in terms of sustainability linked loans, we've participated in about 35 of those, which include housing association sectors. So that sort of helps us understand some of the key themes and objectives that sort of come in, and we can sort of get a good feel for that. And we expect that to continue over time. So that number's only going to go one way, and that's going to go up. In terms of a sector-wide approach, I think it's really important, and through the conversations that we've already had as part of this process, it's really important to make sure that both small, medium, large organisations have an input into this. The regional differences, which make it more challenging to have a uniform sort of ESG criteria, but I think it's really important that those regional challenges are sort of addressed, and not everyone just moves necessarily to a sort of set ESG objective. In terms of the key thing really for us, and I think it was through some of the feedback that I picked up from the white paper, is that around the different questionnaires, in terms of management don't necessarily know what they should be presenting to investors or banks when they're having those conversations. And also just the amount of time it takes, in terms of trying to figure out the right strategy and then trying to report on it. I think the most important thing is coming up with something that helps organisations, both housing associations and banks and investors, to kind of free up time and continue to do what they're good at. The most important thing really for housing associations is to be focusing on providing, safe, affordable homes for people to live in. And the ESG stuff, I guess, has been done, for years. It's more a case of how can you go forward, do more and report on it, which kind of leads us into the point around, what are the benefits in terms of accessing capital? It's quite interesting how quickly that question gets raised when we're having conversations with housing associations. So, I think it's probably just worth saying, from a bank perspective, sustainability is a key priority for us, and we know that that's the case for the broader investor community as well. And it's worth noting that despite COVID-19, that's not gone away. And if anything, it's probably made people take a second look at investments, and that social and environmental, and obviously the governance is really important. But I would say, if anything, it's probably provided more emphasis on that. As a bank, we were one of the first globally to commit to all 3 climate group initiatives around renewable energy, electric vehicles, energy productivity in our operations as well. And from a sustainable financing point of view, so 2018 to 2020, we had a target of providing 10 billion of sustainable financing. We've now doubled that. Over the next 2 years, that's increased to 20 billion. So I think that's kind of a clear message in terms of what our strategy is and where we're moving to, and we're really keen to support that type of investment. And in terms of that 10 billion that was provided, that was a mix of about 3.4 billion of that was to sustainable energy lending, 2.8 billion of that was sustainable linked loans, and 3.7 billion of that was through bonds and private placement. So again, there's lots of different options in terms of accessing capital for the sector. That's always been the case. I think that's going to continue to be the case. I think, as previously noted, the whole point around being able to report on ESG is the fact that it's becoming an expectation, and I think that's fair to say. So being able to report on it successfully is really important. In terms of capital, in terms of the benefits of pricing discounts and all that sort of stuff, from a bank perspective, at the moment there's no capital relief for us. That doesn't mean that will change in due course, and I think it's really important that government provide some input and really influence that. So that's a key thing for us. There are options to structure a transaction slightly differently, if appropriate, based on the ESG objectives of an organisation. It hasn't changed our risk appetite. In terms of the debt capital markets, it's I guess a slightly different situation in that, if you are able to articulate your ESG objectives and report on them appropriately, then naturally you'll open up more investors' interest, get more investors interested, and then naturally the more investors that are interested, you as a housing association, you're in a better position to negotiate better terms. So those are one of the key things that I would flag. And also, it's just worth noting, and this will be my final point, is that that there are regulatory regime changes coming down the line, in terms of EU taxonomy and UK changes to pension mandates as well. So it's really worth sort of taking into account some of those things that are already coming down the line, and how can, as a sector, we build on that and go sort of above and beyond as well. So yeah, that's kind of my update, and I'll pass over to Sarah, who I think is going to give a wider update.
Great, thanks Marcus, and thanks everybody who's listening in. So my name's Sarah, I'm the co-founder and CEO of the Good Economy. We're an advisory firm that specialises in impact measurement and management, and we were invited by Peabody and Centrus to lead and facilitate the development of this approach. And I have to say, we kind of leapt at the chance. For us, this is a collaborative project that really is very mission aligned, and that we're, our core aim is how to influence capital to deliver more positive environmental and social impact. And certainly in the UK, I think many of you are aware there is an affordable housing crisis, and we think the social housing sector has a big role to play in tackling that crisis. So it was very mission aligned. I just wanted to briefly sort of update you all on a little bit the process we went through to develop these criteria and the principles behind them, and then just give you a sort of an update on what's coming next, webinar and the consultation process. But in terms of the process, what we did, you've heard from the other participants, we did 4 things to develop this approach. One is we reviewed all the ESG questionnaires that were coming from investors to housing associations. So I think we reviewed about 14 coming from banks, and Insight was in the group, a whole range of investors. And what we saw is really why finance directors were finding it problematic. It was a lot of different questions had been asked, and many of them were not relevant. They were actually drawing on standard corporate ESG questions that were not actually really relevant to social housing. The second thing we did is we learnt early on, actually, thanks to Clarion, thanks to Gareth, about an initiative led by Ritterwald, who I hope are on the line, but they had developed a certification for sustainability of housing organisations that looked at social and environmental criteria. So rather than reinvent the wheel, we thought, okay, let's look at what Ritterwald have done. And we took that on board, and actually Ritterwald have ended up being a partner on the project as well. So we took what they had done, we developed it, added in governance, which was very critical to investors. The third thing we did is then we reviewed what was happening globally in terms of ESG measures that were relevant, and also what had already happened in the UK. There's been a lot of work done in the UK housing sector on social value measurement, which we recognise and wanted to make sure we understood where that fitted with this approach. So we had long conversations with HACT and some others involved in that. And finally, we ran a series of workshops to really work through and iterate what you now have as this draft set of themes and criteria. And I think one of the sort of unexpected but really positive outcomes of that is that we were bringing together the finance and treasury people from housing associations together with the environmental specialists, the governance specialists, the people who look at sort of rent policy, social issues, community investment. And that turned out to be, I think, for everyone involved, a really good interaction, and brought some of these core issues sort of into the front of, the front line for what finance directors need to be thinking about. So, what we were aiming for is really to develop a sort of consistent, credible and comparable set of measures across ES and G themes. We had three principles that underline the approach. One is that we really wanted to not reinvent the wheel. So where there are already measures that housing associations were using, we would draw on those, or where we know there's going to be regulatory standards coming down the lines, for example, on building safety, that those should absolutely become, what the standards are. The second principle was, we really hope and have aimed that this is an approach that can work for all size housing associations. We're conscious that we've got some of the biggest housing associations in our working group, but it was always meant that any organisation could use the approach. And we've been pleased to see in the feedback. We had a small housing association in Leicester saying this is really useful for us, and they were a small rural HA, so that's been good to hear. But obviously we still want feedback. And finally, we wanted to focus on matters that are important and relevant to the housing sector. So I'm going to ask, the purpose of today is not to go into the criteria in detail. We've got dedicated webinars on that, but I am going to ask Rosie just to share the themes. So for those of you who have had a chance to read the white paper, there we go. So the approach, and this is out there now for consultation, has 10 themes across social, environmental and governance. We put social first because that is traditionally and where housing associations have played a very strong role in providing, affordable housing for people in social need, and the placemaking role came out very strongly there. Environmental concerns are increasingly coming up the agenda, and we have two themes and several criteria there related both to climate change, but importance of ecology, biodiversity, green space, and then governance, very critical themes. So behind these 10 themes, there are 45 criteria. We have now, so looking ahead, so Rosie, let's just take that down. Thank you. So just to talk about next steps. So there's really three streams of work now happening. One is this public consultation. We're really inviting feedback on the themes and criteria. We have a dedicated website, as Luke mentioned, and it's great that we've already had a lot of feedback. And what we're very encouraged by is that is coming from residents. We're going to be doing a dedicated set of webinars with TPAS, with tenants associations. We're getting feedback from housing associations and also investors. So, you know, keep that coming and do join in the next webinars when we'll get into the detail of the criteria. The second stream of work is around the governance, institutional arrangements for where this goes next. So always the ambition is that this will be owned by the sector and ultimately should be handed over to a sector body that represents the different stakeholders. So we've outlined in the paper the idea of, this was new to me, but the idea of a SORP body, which currently exists for financial accounting standards. There is a body that oversees those for housing. And we've been talking to different players about whether we could replicate a similar body for sort of effectively non-financial reporting. So we have been talking to the regulator, the National Housing Federation, got a call tomorrow with the Financial Reporting Council. So we're talking to different actors who would be sort of parties to that. And then the third and final follow-on initiative is with Big Society Capital, we've launched a project to look more closely at equity models that are coming into the sector, some of which are aiming to have impact investing approaches. What we want to do is unpick those models. What are the different equity models? What are their characteristics from both a risk, return and impact perspective? And how can we now look at developing kind of impact reporting standards for those that are taking an impact investing approach? So that's a follow-on project. And if anyone's interested in that, do get in touch. We're running that with a slightly different group of stakeholders, but we think it's an important topic for the sector. So I'm going to stop at that point and hand back to Luke. But yes, thanks everyone.
Great stuff. Okay, lots to take in there. Lots of different perspectives and different points of view, which are coming together, I think, in a really interesting way as to how the direction of travel for ESG and the importance and significance of it in the future. And we've got some really good questions coming in as well. So I'm going to jump over to the questions and ask this one from Lorraine, which we've touched upon a little bit about the timing of this. Lorraine is asking, is it saying these ESG themes have been around for a long while under different guises? What's it about now that has triggered this wave of interest? Does it have longevity, and to what extent might levels of interest change over time? I guess just from my point of view, just to add to that as well, to what extent is this being driven from the financial community, and it's a kind of responsive initiative from the sector? And we're going to go over to Gareth to kick us off with this.
Thanks, Luke. Found the mute button that time. Quite a lot to tackle there, but I think as many of us said, there was a real inflection for me personally last year, not only from the investor community, but also from the general public, the interest in climate change and in sustainability more broadly. And I think that you feel that when you read the news, or watch the news, or however you might consume it. And I think also in the UK, we're starting to catch up. So it's been a bigger deal in Europe for longer, and we're really catching up now. Again, back to that carrot and stick, some of the pension trustee regulatory reporting. But the environment is there now, and we are being encouraged. And I think we can all see the potential now more easily. Part of the challenge before was data and reporting, certainly for our business. I think that is the same for many other businesses. To give an example, it's now possible for us to ask our suppliers, so if we're talking about developers and contractors, we can ask them about their waste management stats, and we can ask them about their carbon footprint. And they're now capturing this data in a way that they weren't, most of them weren't, 5 years ago or so. And I think this sector now has got the possibility to catch up one or two exemplars in other in other sectors because of that. So the opportunity is there, and I think also we can all see the necessity coming down the track through regulation, through what the investor community demands of us, but also our other stakeholders will demand of us. And I think increasingly our consumers, our customers, our tenants will be wanting to know about how we're approaching sustainability as well. So I think it's a combination of those things which has come together over the past couple of years, which has made the timing for this initiative so key. And just to end on that, I think making this broad-based makes it most effective. If we can agree on an achievable baseline for all, we can maximise the impact.
Okay, thanks, Gareth. Anybody else want to come in on that in terms of the timing? It's kind of sounded to me a lot like it's not necessarily doing something different within the sector, but it's partly about the communication of what the sector is doing and the way it's presented.
Partly, but it's also about encouraging. There should be a positive momentum from doing it, as Anthony mentioned, benchmarking not only against one another, but against the supply chain, against other sectors, and exemplars as to who does this well, and kind of learning those lessons, pinching them. So I think the sector can do more, certainly on the environmental, and there's a massive challenge there, clearly. And hopefully, if we can lead the way, we can push our supply chain and government as well.
Okay.
I mean, Luke, just to add that, I mean, I think partly the timing is important because ESG integration is, as you said, it's becoming mainstreamed across the whole financial sector and across all asset classes. And our view is, this has been an opportunity for the sector itself to get ahead of how, what are the relevant, measures and metrics about how it should be assessed, rather than having to sort of respond to what investors' view of what those are. And actually, there is an international project that some people may be aware of called the Impact Management Project, but they're actually now holding up this kind of collaborative effort to come up with an ESG standard as a good practice example of how in other sectors you could actually develop sector approaches that work both for the underlying, housing organisations and investors. So, I think that everybody should be proud of being engaged in this, so that it's seen as quite pioneering in doing it.
Okay, good stuff. Marcus, did you want to come in on this?
Yeah, so I mean, it's an interesting question, the sort of why now. I think it probably doesn't do justice to the sector as well. I think ESG has always been a factor of the sector. There's always been a focus. It sort of hasn't just all of a sudden come about. I think the change is that we live in a new generation now. I think people really recognise the challenges and the risk. The actual sort of tangible risk of climate change. The Paris Agreement and the UN sort of Sustainable Development Goals have really been a key, I guess, sort of driver behind that as well. But I think it's fair to say that potentially the younger generation are now sort of making decisions in terms of investment policies and all those sorts of things. And actually, some of the surveys that have been done in terms of pensions, I think 6 out of 10 people would increase their pension contributions if they know that it was going to some form of sustainable investment. And there was a recent survey that was just done, I think, the other day, asking around what do people think is more important, is an ESG sort of related economic recovery important in the light of COVID-19, and 2/3 of the population said that actually yes, that is still important. So this isn't going away, and I think that everyone's been doing it. I think we need to do more, both in the HH sector and as investors and banks, etc. And we've been going on that journey. There's obviously key regulatory changes which will ensure that we go on that as well. But I think it's more around what do we do that's good. How can we report on that? How can we build on that as well? So I think it's always been about. I think there's more emphasis, and I think it will become the norm, which I think is a positive thing really in the long run.
Great stuff. I'm going to go on to, we've got quite a few questions coming in, so I'm going to move on to the next one. This one is about, there's a question here asking to clarify how this work relates to social value duty, please. So the sort of social value, responsibility that already exists within the sector and the way that that's being reported currently. I suppose there's another question a bit further down which talks about the capacity of associations to actually collect all of this data, including across some of the core metrics. So there's kind of it's two elements to that. One around, how it kind of matches up to the social value stuff already being done in sector, and secondly, the capacity to take on another, kind of data submission, so to speak.
Luke, yeah, maybe why don't I take that? So on the first question, yes, how does this sort of link to the work that's been done on social value? We're very conscious of that work, and we see this in a way as a sort of higher level framework looking at E, S and G criteria, and the social value work really comes into play on some of those criteria. So many housing associations, when they're looking at how they support residents, so there's a theme on resident support, may well use their social valuation analysis to sort of evidence both what they're doing and the impact they're having. So there's sort of there is place for that to fit. And actually Hackton ourselves, came up with a sort of positioning of how the two relate and are linked. On the point about the capability of all organisations to report, I mean, the way it's structured is that there's sort of core, secondary, and then organisational specific metrics, and this is definitely something we want to test out. But the thinking is that the core should be possible for all organisations, whatever size, to be able to report on. Now, we're glad actually the Housing Finance Corporation has come on as the partner in this next phase, so that they have 160 borrowers, some of whom are smaller, and they're going to sort of test out with their borrowers, how realistic that is. We certainly want to reach out and hear, but we're not, what we absolutely don't want is that this has an unintended consequence of favouring, the bigger organisation and enabling them to have easier access to capital at the expense of the smaller ones. That for us would be a negative outcome. So yeah, this should be about enabling the whole market to have access to capital that's aligned socially and environmentally. So yeah, if anybody's finding that these are onerous, or let us know. I mean, we want to hear, and these are draft, right? So they're up for discussion, debate, and we will, after the consultation, be publishing a revised version. So we do want your feedback.
Yeah, there's an interesting point. Another question's coming actually around the kind of risk of this becoming a bit of a league table, that's used to rank housing providers, which has been a topical issue, in recent years.
Yeah, I mean, I don't mind. Yeah, I just really want to take that comment, and others might want to follow up. But this conversation came up quite a lot as to whether or not we should sort of be having the judgment of, well, two things: A, what good looks like, and B, whether there should be some rating system attached to the criteria. We purposely decided not to, in that, and not to say, there will be, I'm sure, ratings approaches that come out of this, but the idea was just to have a consistent, reporting standard, disclosure standard, and then it's really up to investors to judge what they weigh as more important, right? So different investors may have different preferences. But we see this as a sort of disclosure standard for everybody, not about a sort of benchmarking, who's better than the other exercise. And also what we realize, when you start getting into the reality of what good looks like, it really depends on the context. There were lengthy discussions on environmental performance will depend if you've got stock that's 100 years old compared to new builds. So it gets complicated.
Could I perhaps add to that, Sarah, that I think, this has been a very consistent bit of feedback that we've had through there, and I think it's important to pick up on a point that Sarah made there, that good ESG reporting is about disclosure in the context of the business in question. So this is not about housing association A is good compared to housing association B. It's what are housing associations A and B doing in the context of their business model, their locality, their size, and a host of other factors. In the same way that major oil companies report on ESG in the context of them being an oil company fundamentally, it's about the journey that they're on, environmentally, particularly for those guys, as to what they're doing to try and reduce their impact, their environmental impact, and it's an important point to say that this isn't about rankings and sort of comparing one to the other. It's about allowing investors and lenders to make decisions about how good your disclosure is, and are you on a path in terms of addressing potentially areas of weakness and challenge within your business. So and that feeds again through to the large versus small debate as well, because I think we all recognize that if you're a Clarion or a Peabody, you're going to have more internal resources at your disposal in terms of measurement, data, and all sorts of other things than if you're a 500 unit rural housing association. And the bigger organisations may well, as Clarion have done, want to take this forward into accreditation and ratings and going down different paths on the financing route. But again, what we're trying to do here is to get everyone through everyone who wants to, through a sort of basic initial gateway from which then they can diverge in terms of how far or not they want to take this level of reporting and accreditation. So to answer, there's been a few questions I've seen coming through on the kind of, does a one-size-fits-all approach work? Well, I think the one-size-fits-all is sort of getting everyone to that basic sort of level of hygiene as I've described it, and then divergence will naturally sort of take place from there, but at least it'll be grounded in a sort of relatively common approach across the sector at the basic level.
Yeah, Mark, can I bring you in on this, just in terms of the questions here around, we follow on from that, around regional variation across housing associations and different business models, including kind of those that sit within maybe a subsector within the sector. I mean, presumably you would consider all of that when you do any kind of credit quality assessment anyway, right? So does that continue along that line for you? Or?
Indeed, it's just a continuation of the evaluation process that we go through for any issuer. And as Phil has alluded to, this is not about how good you are, it's about where you are on the journey and what you're intending to do. And as Sarah said, if you have all your stock is 100 years old, you can't expect it to be as efficient as if it was all brand new. We understand that. In the same way that associations that have a heavy care business, for example, have lower margins than associations that are all general needs. That's just how it is. We understand that as well. It's about how all this plays into the mix, and it's not about league tables.
Okay. Anybody else, anything to add on that one? Otherwise, I'll move on. Okay. There's another interesting question here. I mean, Phil, kind of you touched upon this a little bit, but there's a suggestion here that other industries have seen finance directors tend to shy away from these kind of measures as they're too difficult or not relevant, or there's some cynicism about how they're being reported, or as one person puts it, how they can be gamed. Does this concern the panel at all?
Well, I mean, Mark made a good point earlier that the housing sector as a whole is good at ESG. It's non-profit distributing. It's in a fundamentally kind of socially sort of good area of the market. It's generally well governed. It's got all the sort of features that long-term investors like in terms of stability of cash flows and all those factors. So to my mind, it's no good being good at that, but not then articulating that story to investors. I think you're missing a trick as a sector if you're not doing that. So you have a natural head start on versus energy companies or real estate businesses or any host of other industries that are getting their act together around ESG reporting. So I think it would be a slightly sort of lazy approach to say, well, it's all a bit difficult. I think the whole purpose of the process we've gone through in the last 6 months has been to get investors and HAs together, and a whole range of other people as well, to try and work through some of those difficult questions. And the consultation period is also about trying to work through some of those questions, as well as ending up with something that doesn't require a whole host of other work to be done. Are you drawing from data that should be readily available from the work that housing associations are already doing? So there's always problems with people gaming data or sort of being selective in terms of what they report on. But I think as lenders and investors, I'm sure will attest that once you've got a framework there, at least you've got a basis on which you can kind of try and dig into some of the detail and ask questions. And I don't think this is a sort of fire and forget process, i.e. you produce your ESG report or statement and that's the end of it. There'll be probing, I'm sure, from the investors and lenders to those businesses as to why they're reporting slightly differently or whatever. But I certainly think it wouldn't be a good thing to sort of avoid it on that basis.
Okay. And then there's a point here as well around kind of auditors being involved, or independent rating agencies, or environmental consultants and so on. Is that something you could envisage being part of the process? Maybe not now, but later. Can I throw that out to the housing associations?
Sure, I'm happy to pick it up, although I think Phil already has. And this is about baseline. This is about picking a standard that hopefully everybody across the broad church that is our sector can get to, and that's the point of the consultation process, and that's the point of asking for as wider engagement on this from as many different stakeholders as possible. But yeah, okay, so Clarion have taken this further, and I would expect others to as well, but it has to be right for your business. Much in the same way as a credit rating isn't necessarily right for all housing associations, or 2 credit ratings aren't necessarily right for all housing associations. You have to see what makes most sense for your business. You are, of course, stewards of your business, and we're not, I don't think anybody in this group would want to create reporting for the sake of it. As others have said, we're trying to leverage from what is already done, and hopefully some kind of industry body, self set up, a sort body or whatever, should promote standardised disclosure and good governance, but also response to the changing operating environment. So I don't think this group envisages, happy to welcome views, but envisages that this should become an onerous, non-value add task. I think we're all excited by actually the potential that it has if it is bought into by everybody.
Can I add a bit to that? I think just in terms of some of the criteria, and I think this will come out in some of the future webinars, really do require not audit, but there are levels of assurance behind the data. And I think also if you're looking to include the ESG stuff in the front section of your report, your annual financial statements, then whilst that's not going to be audited, it is going to have some sort of look over from your auditors. So I think there's an element of that.
Okay, great stuff. There's a few really interesting points here around the role of kind of MMC, modern methods of construction, and how that might figure in the reporting, as well as more around supply chain. I think those can probably be picked up in the future sessions. There's also something around specifics around governance, whether it's appropriate for a trade body like the NHF or CIH to create a body to oversee this activity when we're in a regulated sector industry. That might fit under the governance session, I think. So I think we've covered a lot of ground here, and I think we're actually out of time. Would you believe it? We've sort of raced through an hour. Just to wrap up, then, as I say, this was a bit of an introduction, bit of an overview to the consultation, to the initiative. You can find more at esgsocialhousing.co.uk. Social Housing Magazine, we're really pleased to be a part of this movement. Just a quick plug, we have indeed got our own Impact Investing in ESG conference taking place later in the year, so please don't miss that one. And as mentioned at the start, there will be individual webinars on the E, the S, the G, with specific feedback and on the criteria themselves. So please do come back for those webinars. A recording of today's session will also be made available should you wish to rewatch or share it. But just finally to say, we had around 250 people sign in today. So thanks everyone for your interest. I think it really shows that this topic is an area of interest for the sector and beyond. And I think we've got plenty more to dig into with the future webinars. So thanks again, everybody.